Hi, my name is Grant, and I'm the head of OUTvest. If you've ever wanted to know how your money is invested on the platform, then this session's for you. We're also going to take you through some of the changes that we're making to the investment allocations. But first, let's go over what we're planning to cover. Firstly, we're going to show you what the aim of the platform is. What are we trying to help people do? And has it worked? Secondly, we're going to show you how the money is invested on OUTvest, taking you through some of the detail, and lastly, some of the changes we're planning to make. But let's start at the beginning. Why did we build OUTvest? The purpose of OUTvest is to help people achieve their objectives. And we do this in a different way to the way that is commonly done in the industry. We combine technology, advice, and investment allocations together on a single platform to help people set and achieve their investment goals across a range of different objectives. But I guess the most important question that people are going to ask you is, has it worked? And thankfully, the answer is yes. You see, we track the performance of every single investment contract on our platform since we launched over 4 years ago. And to date, 83% of all contracts on our platform that have started and finished their initial investment time horizon have achieved 95% or more of their objectives after fees, where clients have followed our investment advice recommendations, haven't made early withdrawals, and made at least one contribution. Now, we can't guarantee that this will be the case forever, but we're extremely proud of this result. And this is not rocket science either. This is actually very simple, common sense investing principles that we've embedded in our platform to help people do it. And for me personally, what this shows is that it works. But I think we need to give you a bit more. So let's show you how and why the money is invested on the platform. And you'd be surprised. One of the core principles is the aim to keep things simple. We don't have 500 different funds on the platform. We've only got 5. And with 5 funds, we believe that that will suit the majority of needs of most investors. We are actually planning to add a 6th, and we'll tell you a little bit more about that in the coming months. But let's start with what we have at the moment. We've got 5 funds. One of them is a money market fund. It's actually an actively managed money market fund, and it's run by an organization called Granite Asset Management. And the aim of that money market is to try and give you a return in excess of cash, while ensuring that your money is invested extremely safely and your capital is protected as much as possible. The other 4 funds on the platform are run in a slightly different way. These other 4 funds are run using a method known as passive investing. And passive investing is nothing more than using a recipe or a pre-agreed set of rules that'll help you understand what to buy and to sell in the portfolios. And that, in the world of finance, is called an index. So we developed 4 indices in conjunction with S&P Dow Jones indices and core shares to help us do just that. Now, I think it'll help if we go into a little more detail on one of the index. So let's go into this outstable index. The outstable index is itself a collection of other indices. For example, for South African equities, the S&P SA Top 50 Index is one of the indices inside the outstable index. Simply put, that index says you must hold the 50 largest companies on the Johannesburg Stock Exchange by market cap, with any holding larger than 10% capped. It's a very simple set of rules, and it can be implemented every single day. We also have the S&P SA Sovereign Bond Index, the S&P Inflation Linked Bond Index, SA Property Composite, a global index as well. But if you were to look inside those funds, you would see actually At the end of it, once that index is implemented inside that fund, there's a list of over 120 different holdings. And that's at the moment. You see, Core Shares is the asset manager for the fund, and they get a set of rules every single day. They get the index from S&P Dow Jones, and then they can make a decision on how to implement that index. And in most cases, and this is the list of holdings in the fund, they implement it through direct shares, not other funds necessarily. And they only use ETFs where it's efficient to do so. For example, you can see a Vanguard S&P 500 fund in there. Our belief is that this is one of the most efficient ways to invest at the moment. So, now that we've gone through that, what are we trying to achieve? You see, the funds themselves on our platform have got a number of different objectives to help you achieve yours. One of the first, and probably the most important, is an absolute return objective. And that absolute return objective takes into account inflation. When you invest money, what you're actually trying to do is perform in line with or outperform inflation. And that means that your money retains its buying power over time. Now, for short investment time horizons, we use the Granite Money Market Fund. And you can see that using the annualized return of 3 years to the end of May, that fund delivered 6.4%, relative to CPI at 4%. That is about 163% of its target, and it has outperformed 49% of its peers. Now that's quite a good result. But the same results have been achieved with all the other funds on the platform, the Out Cautious, Out Stable, Out Moderate, and Out Aggressive index funds. They've all performed well relative to their CPI targets and are performing well relative to peer groups as well. Now, this is something we can't guarantee. It's not to say that next month we can get results exactly like this or into the future, but that's something we monitor carefully. The aim, or what we're trying to achieve, is to outperform at least 50% of our peers over rolling 3-year periods, while of course trying to hit those CPI targets. But again, just to reiterate, these are real numbers. They are not back-tested numbers. This is real life performance for the funds, benchmarked against their peers. But again, I'd just like to warn you that we can't guarantee you that this is what will always be the case in the future. So let's look at what else we're trying to achieve. You see, one of the most important things that we do is we offer automated advice. And so we have to make sure that each of those funds on our platform conform to a set of risk and return profiles that we set. Now that's, for us, is incredibly important in making sure that when we provide a recommendation for the fund on the platform, that fund suits the recommendation. And so let me explain these charts to you quickly. On the left, if you're looking at the screen, you've got a chart that says 5-year rolling risk to the end of May. And on the right is a chart that says cumulative returns to the 31st of May. Going back to the left, this is a measure that we use to understand risk. It's a simple measure. And if you're mathematical, it's called standard deviation. It simply measures the volatility of the price of the unit trust over a period. And if you were to read the chart simply, the Out Aggressive Index Fund has got the highest variability in its price, and the Out Cautious Index has got the lowest variability in its price of the funds on this chart. Now, the funny thing about investing is that risk and return are usually related. It's not a true mathematical constant, but there is a relationship between the two. And you can see it in the return chart. You can see that, and a lot of these are back-tested numbers, so it's not the same as the previous slide, but the Out Aggressive Index Fund, the Out Aggressive Index itself, has provided a higher cumulative return than the Out Moderate Index, the Out Cautious, and the Out Stable Index. However, that index over short periods has got a much higher variability in its price or in its value over short periods of time. Now that's something we need to be very, very careful of. So when you're investing for a short period of time, it may well be that that index could fall incredibly sharply and you won't have enough time to recover from that before you withdraw your investment. So there's a better risk and return profile over the short periods that you might get from the OUTcautious index. And you can see from that line, the OUTcautious index line on the cumulative return chart has got a much more gradual variability in its price levels. Now this is one of the things we evaluate very, very carefully, and it's important to make sure that we provide a good recommendation based on your circumstances. Okay, but that's one part of it. But how do we make sure that we keep ourselves honest? Well, we've got two governance processes that we use at the moment. The first is the Index Advisory Committee. This is a committee made up of people from inside OUTvest and external individuals who sit on a committee. The purpose of that committee is to make sure the indices that CoreShares tracks in the funds do what they're supposed to do. And so we get reporting from S&P Dow Jones in every quarter. They look at index performance, we look at the design and construction, we look at regulation, and we try and understand what drove the performance of those indices over the period. In addition to that, we've got another investment committee, which is strictly OUTvest. And in this OUTvest investment committee, the aim is to understand a couple of things about what's going on. Firstly, we want to understand what's going on in the markets and the economy, both in SA and globally. We also look at the fund performance, including the peer group performance, as well as understanding whether CoreShares and Granite are achieving their objectives or looking after the funds. And most importantly, the question we need to answer in that committee is, are we still happy to recommend this to our clients? Now, I think it's really important to note that these are not the only committees that are used in the governance of the funds. CoreShares themselves have got an investment committee to make sure that they are also adhering to the mandate of the unit trusts that are on the platform. Granites have got their own committees, and there are tons of governance processes to make sure that the fund does what it says on the tin. So there's a lot of governance that sits behind, or a lot of quality that sits behind the investments that sit on the platform, and we're very, very comfortable with them. So the key thing that I think I'd like to take you through now is, what are the changes that we're making to these indices and why? If we were to summarize these changes, they'd be the following. Increasing cash and lower risk indices. So during 2020, when the markets fell very sharply, we saw that the OUTcautious fund didn't protect our investors' interests as well as we would have hoped. And so what we've done to prevent that happening in future is we've increased the weighting to cash in those portfolios. We've also increased the offshore weight across all of the indices to try and make sure that there's greater diversification across currency and other asset classes. Within the global equity allocation, we've increased the weights to emerging markets. That's a structural allocation. I'll explain it when we get there. We've increased the exposure to nominal bonds versus inflation-linked bonds. We've reduced listed property as a separate asset class in some of our indices, and we've adjusted some of the risk and return trade-off in all of the indices to make sure that they're still doing what we believe is right for our clients. Let's go into a little more detail. So you can see from this chart that in the OUTcautious and the OUTstable index, we used to have 10% in cash, and the new changes are bringing us up to 21% in cash. The same with the OUTstable index. This is purely to provide more protection in the event of market volatility. There's been no change in the OUTmoderate and OUTaggressive index because those indices don't typically hold a lot of cash, because their aim is to try and outperform inflation over longer time periods. And generally speaking, equities are the evidence suggests that equities are a better way of doing this. In the offshore weights across the indices, you can see that we've increased the offshore weight significantly across all of the indices. Now, this is not purely obviously in equities. It uses a range of different asset classes, but again, the currency diversity has increased across the out cautious, out stable, out moderate, and mostly the out aggressive index. In fact, in the out aggressive index, the offshore weight of the portfolio is now 45%. So nearly half the portfolio invests offshore and the other half onshore. And this was purely from a protection point of view, to make sure that we try and retain the store of value for our clients' wealth. The other bit we've done within our global equity allocation is we've increased the weight to emerging markets. Now, if you were to invest in a global equity index that covers the entire world, there's something funny about it. You see, if you were to do that, most of the indices, such as the MSCI All Countries World or the S&P Global 1200, they've got quite a small allocation to emerging markets. So Brazil, Russia, India, China, and other what is considered to be emerging markets. About 10-12%. However, if you looked at the comparison of gross domestic product between the emerging and the developed world, well, that's much more closely balanced. It's more like 60-40. And so what we felt is that over time, the market weight that emerging markets would have in these global indices will increase. And so we've tried to position slightly ahead of that by increasing the weight to emerging markets relative to developed markets in our global equity allocation. Overall, at the portfolio level, whilst this is important, it's not everything. It doesn't change the way that the portfolios work. It's more just what we call in the world of portfolio construction, we call it a tilt. In terms of nominal bonds, when we put these indices together over 4 years ago, one of the reasons we incorporated a large weighting to inflation-linked bonds was because of our concern about outperforming inflation. And generally speaking, when you get unexpected inflation or when there is positive economic growth and potential for inflation, inflation-linked bonds tend to do quite well. However, this hasn't been the case. And so what we found is that, or what we believe is that sovereign bonds are probably more sensitive at this stage to changes in South Africa's economic prospects than inflation-linked bonds. And so what we've done is we've reduced the allocation to inflation-linked bonds, increased the allocation to sovereign bonds, but reduced the overall bond allocation as a whole, moving some of it to cash to provide more protection for our clients. The last thing we've done here is we've reduced listed property as a separate asset class. In our indices, we actually stripped out listed property and we held them as separate index allocations across all of the indices. Now, obviously, what we've seen in light of the pandemic and as a result of what's happened over the last couple of years in particular, is that property itself has struggled a lot. And what our feeling is that we're not quite sure how property use will change in the future as a result of COVID-19. In addition to that, some of those property allocations are already held in our equity allocations because a lot of these are listed property companies or real estate investment trusts. So we've reduced that weighting to property as a separate allocation and instead increased the equity weighting in the portfolios. And lastly, what we've also done is, of course, we've taken the time to make sure that the risk and returns profiles are better balanced. In the previous chart you saw a bit earlier, there was a gap that was starting to open up between the out stable and out moderate index. And whilst that gap wasn't worrying in itself, we thought it was a good time to go and do some maintenance to try and rebalance that risk and return trade-off in the indices. Right, so that's it. Thank you very much for your time. And if you have any questions at all, please don't hesitate to get in touch. We'd love to take you into any more detail if anyone would like to know. But thank you once again. We appreciate your support and we look forward to helping you achieve your objectives.